Okay, so Alex can hear me, right, Alex? Audio working, Okay, good. We will be kicking start with the quiz really shortly. So from yesterday's experience, okay, from the quiz earlier, the quiz that we have done yesterday, for fiscal policy, okay, a sizable amount of students cannot differentiate between indirect and direct tax. Okay, so later on, okay, you're supposed to look out for questions that are centric around direct and indirect tax. Okay, so let me repeat. Okay, a direct tax is going to affect your income and profit. Okay, primarily AD. Okay, where indirect tax is going to what? It's going to affect your production costs. So you have to quickly differentiate the two. Okay, and I don't have much bandwidth to do a recap. Okay, so I will probably recap using the quiz directly. Can? Okay, so I'm going to share the quiz. Okay, this is the answer. Sharing the wrong slide. Okay, I'm going to share the link. Okay, on the chat. Okay, join me. I'll put it under to everyone. I won't be able to wait for everyone to join. Huh? Okay, so we'll kickstart with whoever that's in the class first. Okay, so if you like, you can play around with your avatar. Let me know. Okay, if you're okay. Who else is not in? Okay, Alex. Okay, all good with your avatar? Okay, ready? Okay, let's begin. I don't think you need a calculator though. Yeah, go ahead with your breakfast. I'm happy with that. Share with me if you can. So distinguish whether this is a direct or indirect tax first. That's my hint. And somebody already answered. I hope you get the right one. For the latecomers, you can do this on the side. Okay, for the latecomers, you can do this on the side. Any questions that you get wrong can sound out later for the latecomers. Thanks. Was that a tricky question? I don't think so, right? Everyone chose the correct wrong answer. Alright, congrats, Mr. or Miss A, can't tell. I will wait for the report to be out. Whoever that made it to the podium. Okay, I would like to view summary. View full report. Okay, and let's see. 52%. Wow. Okay, it's not a fantastic stats, huh? So we have two questions that were all right, 7 and 8. Okay, so for the remaining questions, okay, I will cover them okay together. 7 and 8 are all correct. So what would be an expansionary fiscal policy? An expansionary fiscal policy will what? Okay, increase AD, right? Okay, so a budget deficit will lead to a rise in G, and a fall in T. Okay, so a fall in T will lead to higher C and I. So this is expansionary. Some of the students brought up money supply. Okay, money supply we'll be learning today. Okay, increase in money supply will lead to a fall in interest rate. Okay, it's an expansionary monetary policy. Okay, not fiscal policy. Okay, any questions that you have for me, you can put it on the chat. Okay, I'll pick it up. This is a indirect tax, labor tax. Okay, this is going to affect your production costs. So you have to distinguish between direct and indirect tax. Let me close this at the side. Do you think I can close that? I don't think. Oh, I think I can close that. Yeah, bigger. Okay, so indirect tax. Okay, you have to understand that this reduces the production costs. Okay, so your SRAS curve is likely to be affected with lower production costs. Okay, so SRAS curve will what? Shift downwards. Okay, when SRAS curve shift downwards, okay, this will lead to lower general price level and higher output level. Okay? Okay, so this one affects your income distribution, okay, or income inequality. So I will cover the one on the right hand side first. Easier, indirect tax. Now, what are some of the examples of indirect tax? So earlier on, I've actually mentioned already things that mention your production costs. And one of the most representative indirect tax is what we call GST, right? Okay, goods and service tax. So you have to understand that why GST, okay, is, later on there's another question about regressive, right? Okay, what is regressive? Okay, regressive simply means that the lower income earners pay a higher proportion as tax. Okay, and it's going to worsen your income distribution. So this is one thing that you need to take note. Okay, so you can see that this question is asking about worsening the income inequality, right? So indirect tax has to go up. So far, so good. Okay, regressiveness. And for direct tax, you realize that it has to fall. Okay, most of the direct tax are progressive, if not proportional. Okay, so progressive tax are such as what? Okay, your personal income tax. So if it falls, it's become less progressive. Okay, less progressive is going to worsen your income distribution. Okay, now this question is a little bit tricky. Okay, it really tests you on your concept of progressive and regressive. What is most likely to, let me check the report again. Question 7 and 8 we can skip. What is most likely to be increased by a policy of increased direct tax? So this is what? Okay, this is contractionary. There's contractionary effects, right? Okay, so when there's a contractionary effect, higher direct tax means lower C and I, lower G. Your level of unemployment must go up, especially demand deficient unemployment. Okay? If you don't understand any other options, you can also list out why not this, why not that. Okay, if I have bandwidth, I'll address that during the break. What describes a regressive tax? So you can see that higher income earners pay a lower proportion of income as tax. Otherwise, lower income earners pay a higher proportion of income as tax. This is regressive. So I just have to make a mental note. Okay, this week, okay, for the J1 classes, I'll be going through tax and subsidy. I will also be going through in depth, okay, what's the difference between direct and indirect tax. Okay, so for students who would like a refresher, okay, this is my suggestion to come for the J1 class, yeah? Okay, so despite being regressive, why would the government still want to raise GST? Okay, just now we mentioned that GST is regressive, right? Lower income earners will pay a higher proportion of their income as tax. So why is Singapore government, especially this year, okay, GST actually rose, right? Why? Then you have to ask yourself, okay, what is the problem that Singapore is facing? A aging population. Okay, what else? Okay, you can see that aging population will lead to a higher expenditure on healthcare, especially on the elderlies, right? Okay, so this is going to lead to what? Okay, your budget position is going to worsen. So GST, despite being regressive, okay, one of the plus or pros is it's a broad-based tax. Broad-based means what? It means that it's a tax on expenditure. Most of consumers, okay, they spend on goods and services. Okay, so you will incur GST whether you like it or not. 7 and 8, everyone got right. Okay, I hope there's no tikam involved. Otherwise, check with me. So what is a good example of automatic stabilizer? Okay, I'm not sure why everyone picked green. Okay, but I'm pretty sure red and blue is not an automatic stabilizer. Okay, they are what we call discretionary spending. Okay, or discretionary expenditure. Government spending is a discretionary fiscal policy. There's an act of government. Reduction of income tax during recession is also an act of government. Automatic stabilizer is what we call non-discretionary fiscal policy. Nothing needs to be done. Okay, so during a recession, higher unemployment handouts will be dished out automatically. Nothing needs to be done here. Okay? I'm not sure why. Maybe for everyone who picked green, maybe you want to share with me why you all like green so much, yeah? Okay, and the last one, a fall in indirect tax will lead to what? Okay, it will lead to lower price level and higher employment, right? SRAS curve shifting downwards due to lower production costs. Yeah, indirect tax, yeah? Okay, so I think sometime in the future, we'll be attempting an essay that is related to this. Oh? So with this, I hope you all have some clarity or some good recap on your fiscal policy. I am going to close all this. Okay, I am going to move on to today's topic. The profile and mix of today's class is significantly different from yesterday. Okay, so I'd just like to check, okay, with the exception of Raj and Shripad. Okay, for the rest, have you all learned, and maybe Alex, okay, the other remaining few, okay, have you all learned monetary policy in school already? Okay, I see one hand up. Okay, the other two shaking their head. So I have quite a diverse profile here. I have students who have learned that some time back. Okay, let me put my head bigger first. Expand my head. Handsome face. Yeah, this is the YouTuber style. Yes. Yep. Okay, so I have some students who have learned that some time back. I have some students who have recently learned. What was the animation? Okay, this is my trade secret. Okay, not supposed to share. Yeah, I'll share it with you all privately, like if you all want. Okay, it's not difficult, but you need this software called OBS, right? Okay, and yes, okay, and I have students who have never learned this before. Okay, so the trick of monetary policy is you have to borrow some of the concepts from fiscal policy. Okay, so the things that we'll be covering, they are oddly similar to fiscal policy. Oddly similar in the sense that how we're going to cover this topic. Okay, starting technique is the same. So if you still recall, fiscal policy, somewhere 2 weeks back, we covered the perspective of what? Expansionary and contractionary, right? Yes, still remember? Okay, so today is not too different. Okay, expansionary and contractionary. But monetary policy can be exceptionally confusing, especially for students who are new to this. Okay, so I will attempt to simplify your life. Okay, for those who have your notes with you, you can make close reference. For those who don't have your notes with you or haven't received, okay, then you may want to make mental notes. For those with the book with you, you can also take out your book. Okay, we'll be using the book quite extensively today, can? And I'll point out to you what are the things that are important and what are the things that you can afford to skip, okay, in your notes. Okay, so I will be going through several of this. Okay, so it looks really daunting. Okay, I will just quickly cover. Okay, we'll be going through what is monetary policy, what are the different types of monetary policy. Okay, central bank. Okay, what's the role of the central bank? We'll be briefly touching on quantitative easing. Okay, and for this particular long phrase here, don't be too scared about that. We won't be going in depth. Okay, most of the schools have placed it under appendix. Okay, concepts of MEI, I will go in depth later. This is something that you need to know and you need to use it in your essay question later. Effects on C and X minus M. Okay, I'll briefly touch on that using the book. Okay, and I'm going to go through all the 4 macro goals. Okay, for my H1 students, you don't need to know balance of payment. There are some limitations that you probably want to consider. I will talk about how monetary policy and the limitations that's involved, okay, particularly the constraints and unintended consequences, and how is it going to come out from an exam perspective. Okay, so this is a 3-part series. So today we'll be covering the interest rate based monetary policy. Next week, okay, there will be 2 classes. Okay, Friday morning 11:30. I hope you all still remember, right? Your date with me during Good Friday. Yeah, that one there is no backup class. Okay, and the weekend classes. Okay, so this is a 3-part series. Okay, we'll be going through the interest rate and the exchange rate version of that. So with this, okay, I will move on to the definition. Okay, everyone, okay, page 95 for those with the book especially. Okay, and I will look out for the book. Okay, so how do we differentiate fiscal and monetary policy? Okay, key point, how to differentiate. And one more thing, because I am using this specific software, okay, sometimes my head will block some of the writing. So if my head is blocking, you just let me know, because I have to monitor 3 screens. Okay, so I will scroll downwards a little bit more so that you can see more. Okay, or I will move my head away. Can? Let me know if my head is blocking any of the text. How do we differentiate fiscal and monetary policy? Number 1, economic agent involved. Okay, so you can see that fiscal policy, we are concerned about government. Monetary policy, we are concerned about what? Central bank. Okay, so I just want to make a mental note. Government and central bank are not the same. Okay, there are 2 independent bodies. Okay, 2 independent bodies. So they make separate decisions as well. Okay, so for government, for fiscal policy, we are concerned about G and T. Right? This is done 2 weeks back. For monetary policy, we are concerned about interest rate. Okay, so government does not control interest rate. Likewise, central bank does not affect G and T. Is everyone following me? So long as you get the basis right, you get the economic agents right, okay, more or less you're there. So when you look at the extract, if they tell you government, please don't propose central bank, please don't propose IR. Okay, and vice versa will hold true. Okay, so today we want to zoom into central bank. Okay, we'll look at IR, I forgot exchange rate as well. Okay, interest rate and exchange rate. So you can see here, instruments adopted by central bank to influence the level of economic activity. Okay, so this one I need you to copy down. or different types of monetary policy. You can copy it here. Okay, so I have already coincidentally have written down. So there are two types of monetary policy. Two types are page 95. Page 95. You can just jot it at the side here. So for monetary policy, okay, there are two types. The two types of monetary policy that we are concerned is interest rate and exchange rate targeting. So I want to go into the mechanics of interest rate and exchange rate targeting and why is that so. Different economies have different needs. Okay, so let me repeat. Different economies have different needs. But the long story short is most of the economy can only pick interest rate or exchange rate targeting. Most. Okay, so I just want to put it on record right now. If the question, okay, tells you, okay, how do we know whether the question requires you to adopt interest rate or exchange rate targeting? Simple. Look out for the context. So for context, you want to look out for exchange rate, look out for Singapore. Why are we learning exchange rate targeting, okay, in next week? Okay, it's because all about Singapore. All right, Singapore is all about exchange rate targeting. We do not target interest rate. So the moment you start proposing interest rate based monetary policy for Singapore, you will go off tangent. Okay, it will be straight out of the picture already. Okay, point of no return. I've seen so many students proposing the wrong thing. So far so good. Exchange rate, okay, Singapore. Interest rate, I will put this broadly under rest of the world, ROW. So if the question did not specify which country, okay, then you can use interest rate. United States, interest rate. Right? Europe, interest rate. Japan, interest rate. All the major economies, generally interest rate. Okay? So there are only that handful of countries that can influence interest rate and exchange rate. I will not go into that because there is not not within your scope. So I won't go into that. Okay, so today we'll be looking specifically at interest rate, okay, at the rest of the world, what they are doing, and how the rest of the world central bank influence economic activities. And the two broad terminologies that we'll be using is not too different from fiscal policy. So we have to know that monetary policy is also broadly a demand side policy. It influences your AD through interest rate. Later on I will show you the connection. So the two broad terminologies that you have to consider is expansionary monetary policy and contractionary monetary policy. Is everyone clear? Expansionary and contractionary. And I want you to put a star down here. Star this like 3 times. Because I have seen so many students proposing the wrong solution to the wrong economy. And there you go. Your essay is going to be flushed down the drain. Interest rate and exchange rate. So which one is more likely to be tested? You have to understand that you are sitting for a Singapore paper. Right? So exchange rate has a higher chance. Or exchange rate targeting or exchange rate based monetary policy. Interest rate can still be tested. But like I've said, focus a little bit more on ER when I cover that. Is everyone clear on the priorities? So what is the role of a central bank? So this is good to know. There is no need to copy this down. So just now we actually knew that the central bank is in charge or is interested in influencing economic activities, right? In other words, we can deduce that macro objectives is part of what central banks is concerned about, macro objectives, right? Now let's put things into context. Recently, you've seen that a lot of banks go into trouble, right? Yes. I think it's quite timely to share this. So which are the banks that went into trouble? We have Credit Suisse, we have Silicon Valley Bank. So all of you are relatively good in touch with the recent news. So what's the role of the central bank here? So you also have to understand that the central bank has another role, which is also related to macro objectives. Okay, you may want to pen this down. They are known as the lender of last resort. In other words, they are the mother of all commercial banks. All banks. Okay, is it investment banks or commercial banks? It's not within the scope in this particular lesson to cover what is the difference between commercial bank and investment banks. I'm not going to cover that. So in other words, okay, central bank here is there to what? Okay, provide liquidity. Okay, provide money. Okay, to banks that run into trouble. So you can see that Credit Suisse ran into trouble. Okay, if you read the news, they are going to be acquired by UBS. Okay, one of their rival, right? So in this case, you didn't actually see that. Okay, the central bank has intervened directly by providing Credit Suisse with money, right? Okay, but you can see that there are a lot more other ways that the central bank, okay, can intervene. Okay, they can pressure UBS to acquire Credit Suisse, right? If not, I revoke your banking license. So there are some of the things that you don't see on surface, but it's happening. Okay, so lender of last resort, okay, is important, and you also have to know that, okay, the role of central bank is to ensure that there is financial stability, because it's exceptionally detrimental if a bank goes into bankruptcy, right? Depositors especially cannot get back their deposits. Okay, so for central bank in Singapore, okay, they actually provide this insurance scheme called Singapore Deposit Insurance Scheme or commission. I can't recall what is the exact term. Okay, in other words, it means that, okay, if the financial institute that you have your deposit, okay, goes belly up, goes into bankruptcy, goes into insolvency, like Credit Suisse, for instance, okay, your deposit is insured up to 50,000. Okay, so the central bank will provide a guarantee on the deposits of up to 50,000. Right? So that this is going to stop people from, okay, making panic withdrawals from the bank. Okay? So we don't really need to know a lot more about central bank unless you have a genuine interest to, intern at MAS, or you want to submit an application to MAS. Then you talk to me. Okay, I'll prep you for the interview. Okay? So, okay, next, okay, I'm going to move on to the tools of central bank. This is also good to know. So I know that some of your school notes, they will go through in depth, okay, how does the central bank, okay, conduct monetary policy? Okay, how does the central bank uses money supply? Anyone, okay, have learned that in school? Been discussed in school? Okay, so like I've said, only if you have a genuine interest in monetary policy, okay, then you look deeper. Otherwise, it's not required to know. Okay, so I'm just going to give you all some very broad headings on how to deduce. Okay, what kind of tools central banks are using. So first of all, you have to deduce whether is it an expansionary or contractionary monetary policy. You have to deduce this first. Okay, later on, I will explain the effects. Okay, so for expansionary monetary policy, okay, you want to look out for what? Recession. Right, look out for headings such as recession, unemployment. Right? Okay, what other terms are there that requires you to inflate the economy other than recession and unemployment? Okay, maybe, I think pretty much that's it. Okay, and you also, balance of payment, not usually in monetary policy. Later on, I'll explain. Okay, it's not conventional to use monetary policy because there's opposing effect. Okay, so for contractionary monetary policy, okay, you have to deduce things such as what? Overheating. Right? Okay, you want to cool down the economy. Okay, what else? Okay, inflationary pressures. So you have to be exceptionally sensitive to problems first before we can deduce whether you need a expansionary demand side or expansionary or contractionary demand side policy. So for central bank, all you need to know is they play around with interest rate. Okay, so if you want more economic activities, you lower interest rate, which I will explain later. Okay, if you want lesser economic activities, you raise interest rate. Okay? So sometimes central bank, okay, if you read the extract, they will use very, very contextualized lingo or jargons. So you may want to look out for interest rate hiking. Okay, I don't mean that we go for a literal hike, okay, but it simply means that it's going to raise the interest rate. Right? So sometimes, okay, animals can also come into part. You realize that if you read the economies, right? Anyone subscribe to the economies? Have or not? Okay, so you can see that sometimes animals also come in the picture. Okay, so you can see that sometimes dovish, okay, is related to a bird, right? Right, it's a bird that represents peace. Okay, it comes from dove lah. I think so. Yeah. So it means that, okay, the central bankers are what? Okay, they are generally, okay, they want to set a low interest rate. Okay, so you can see that another term that I don't think it will be tested. Okay, you want to look out for hawkish. Hawkish come from the hawk, right? Aggressive. Okay, I'm sorry if my head has blocked. Hawkish. So you can see that when central bankers are known to be hawks or hawkish, it means that they think that there's too much economic activities. They want to raise interest rate. So there are a gazillion terms to describe monetary policy. They won't tell you expansionary or contractionary, that's for sure. But you have to make use of the extract to deduce. So most of the time, these two will be present. Most of the time. Right? So sometimes in the extract, okay, they will also point out to you either of these three. So you have to deduce from the tone whether is it expansionary or contractionary. If you read the extract carefully, if you have gone through all the terms, you should be able to make a reasoned argument, okay, whether is it contractionary or expansionary. So this is one of the most widely used discount rate. Okay, so I will just broadly talk about this. Okay, a discount rate is another type of interest rate that is offered by the central bank. Remember, a central bank does not deal with commoners like you and me, right? I don't go to the central bank to make a loan. Where do I go to? I go to DBS, I go to UOB, right? For instance. Okay, so you can see that central bank, okay, will deal with commercial banks. Okay, and commercial banks will deal with the general economy, like us, okay, households like us. So in other words, the central bank can use discount rates, okay, to influence economic activities, okay, by lowering or by raising the borrowing rate. Okay, commercial banks can also borrow from central bank, right? So you can see that if the central bank is making it more costly for commercial banks to borrow, then the commercial banks itself will what? Okay, will restrict lending in the economy because it's more costly to borrow from central bank right now. Okay, so generally discount rate, okay, correlates with the interest rate or the cost of borrowing you see that is offered under the commercial banks. So there are a gazillion terms to relate to interest rate. Okay, so generally they are loosely lumped under cost of borrowing, loosely. So far so good. So later on in the extract, you probably can see how a discount rate is used later, okay, in actual terms. Okay, I will leave it to you to play around. So I won't go through all these three. Okay, if you want, okay, you can pick up finance, or you can pick up financial economics as a module in university. So they have a good place in university. Okay, I just want to make use of page 108, okay, to cover a more modern illustration of monetary policy. Okay, page 108, everyone. You can see that page 108, we talk about is it page 108 or 103? At 108. Quantitative easing. So without looking at the context, you have to deduce. Okay, what is easing? Okay, easing simply means what? Okay, the central bank or the economic agents, central bank specifically, they want more activities, right? If not, they wouldn't ease, right? Oh yes, another term that you want to consider, okay, I forgot to mention earlier on. Okay, you want to use this. Okay, easing, credit easing, and credit tightening. I'm so sorry, my head has blocked the screen. Tightening. Okay, I move my head a little bit. Tightening and easing. So there's a lot of terms that can be used to explain monetary policy. You have to infer from them. So easing means what? Easing simply means by injecting more money supply into the commercial banks so that this will lower interest rate. So all we need to know is that when there is excessive or a surplus of money supply of money, this will lower your interest rate and cost of borrowing. I'm just going to offer you all some really simple heads up. You don't need to know the general mechanics. Likewise, if there's a tightening or what we call a shortage of money, so this is going to restrict credit. So interest rate and cost of borrowing will go up. So quantitative easing, or QE in other words, is another form of expansionary monetary policy. By lowering interest rates, you can promote more economic activities, which I will share with you in a short while later. So I don't think there's a term called quantitative tightening. QE was actually developed some years back to fight the Great Recession. So I'm done with QE. QE you have to look out. So Keynesian liquidity preference theory and theory of loanable funds. So do you all vaguely see that in your school notes? The downward sloping the downward sloping money supply. Sorry, the perfectly inelastic money supply and the downward sloping money demand. Yes. All right. So if your school ever use these two terms to describe how interest rate is deduced, or how interest rate is how interest rate is determined, no need to learn about that. So I think it's a little bit too much. During my time, many years back, I learned about this. But all we need to, like I've said, is to make a clever deduction, of what type of monetary policy, expansionary or contractionary. Right? Expansionary, we need to look at the circumstance that requires us to pump prime the economy. And we have to look out for a circumstance to contract the economy when there's overheating, etc. So these two terms, if you ever see it in your school notes, you can just cross it out. Just move ahead. Unless you have a genuine interest to find out more, then you ping me. I'll cover more in depth. So now the next thing that I want to cover is really important. This one very, very important. Everyone, please flip to your book, page 66. I will use page 66 to explain how monetary policy works. So we will be using MEI. So some of the schools don't use this. Some of the schools does. So I am leaving to you, whether you want to adopt this or not. But I'm going to explain to you the mechanism and why should we prioritize MEI in our explanation. So first of all, we have to know what the diagram is talking about and why is it important. I will put the Shripad, thanks for going to mute. So we can see that we want to focus on the left side diagram. Left side diagram. Wait, where's my pen? So we can see that there is a downward sloping curve called MEI. MEI stands for what? It stands for the marginal efficiency of investment. So it also roughly measures the rate of expected profitability from an additional investment. Marginal tells us this is the last investment. So you may want to be more specific. Additional investment. So we can actually see that your MEI is downward sloping for a good reason. What does it tell us? It tells us that when we step up in our level of investment, the rate of expected profitability will fall. Why is that so? Good, Raj. So the reason behind it is because of diminishing returns. So firms will have to evaluate on what type of investment project that they will have, right? Agreed? So you can see that for the initial first few investment projects that they are offered, okay, they are probably going to be very profitable, right? Firms will expect great or huge profitability for the first few. But are we going to anticipate that all projects or all investment expenditures are going to give you the same amount of profitability? Unlikely, right? Some of the projects will be more profitable than the rest. So the MEI curve tells us that it's downward sloping. It simply means that when we invest more and more and more, okay, the expected returns or the expected profitability from an additional investment will fall and will go lower and lower and lower. So essentially, okay, if this helps you, okay, you can actually see this as your demand for investment. Okay, but we use MEI lah. Okay, you realize that these two curves are oddly familiar to demand concepts, right? Shifting and a movement. Okay, so you can see that. Okay, this is a movement down here. You can see that when your rate of investment is lower. Okay, sorry, when your investment goes up, okay, your expected profitability falls. Okay, and you will cut back on your level of investment. You'll increase your level of investment. Give me a second. Wait. Yes. Okay. So we start off with let me go stun a little bit. Let me go back a little bit. So it simply tells us that the more investment projects that we were to invest, the lower expected profitability we will have to accept. Okay, lower expected profitability. Sorry, I got confused for a short while. Yeah, I'm going to introduce you a second concept here. So you can see that the expected profitability here, okay, simply tells us is measured in percentage. Now, okay, I'm going to introduce you another curve here. So you can put a slash here. Your marginal efficiency of investment, put a slash here. Okay, you can see that the y-axis can also be measured in terms of your cost of borrowing. Okay, please insert this here. So this particular diagram only explains half of the story, half only. So I'm just going to draw a horizontal line here. Okay, you can see that your cost of borrowing, let's call this R1. Okay, let's come out with a hypothetical value of R1. Okay, this is what? 5%. Okay, so I'm just going to thicken the MEI curve. Okay, this is your blue MEI curve. Is everyone following me? Okay, I'm going to blow this up. First of all, we know that firms, when they want to invest, they have to consider the expected profitability or the expected returns, right? And another consideration that they have is their cost of borrowing. Why? Because they have to borrow from financial institutes before they can engage in any form of investment. That you following me? So, we see that there is an intersection here. Okay, so what does the intersection here tells us? It tells us that your expected rate of return, or your MEI, is equals to your cost of borrowing. So, firms will what? Firms will borrow up to 5%. Or rather, when your expected rate of returns is equals to your cost of borrowing, they'll invest up to I1. This is your optimal investment level. So if you understood marginalist concept or marginalist principle, okay, it's exceptionally easy. Okay, your expected rate of returns, you're looking at the last level of investment. Okay, your cost of borrowing, we're looking at the last unit of investment that you invest in. What is the borrowing cost? Okay, so you can see that when both of them equates, it means that this is the sweet spot that a firm should invest. Okay, they will invest up to 5% at I1. Okay, this is a hypothetical number. Okay, so from a mathematical perspective, this is what we call simultaneous equation. Right? Okay, so when two curves cut each other, you can see that there is an equilibrium interest rate and an equilibrium investment level. Now I'm going to move on. Now I want you all to focus this. What happens when interest rate goes down? Okay, so let's say hypothetically interest rate went down by 3%. Okay, so you can see that the firm can borrow at 3%. Any amount of capital to invest, 3%. That's why it's horizontal. I forgot to mention that earlier on. Okay, the red line, okay, cost of borrowing is 5% at any level of investment. Now, okay, I want you all to observe this gap. You can see that when interest rate goes down, it's going to create a disequilibrium. You can see that your expected rate of return here is still 5%. Okay, I1. Okay, but you can see that your cost of borrowing has reduced to 3%, right? So what does it tell us? Okay, so this particular gap down here tells us that your expected rate of returns right now exceeds your cost of borrowing. So now think through. Okay, if a firm finds that expected rate of returns or the profitability from the project exceeds the borrowing cost, right? Now type it out. If you are a firm, would you borrow more to invest or borrow less to invest? Type it out. If your expected rate of returns exceeds your cost of borrowing, for every investment that you engage in, okay, the returns is higher than your borrowing cost. You want to invest more, right? So you can see that because of this particular scenario here, your net returns, your net, okay, important, I put here, net expected returns will be higher. There is net of borrowing cost. Net expected returns will increase, or net expected returns will be higher. So now, okay, we are going to increase to, let's say, I1.5. Okay, I'm just going to show you some hypothetical numbers here. I1.5. Yes, okay, returns can also be considered in terms of percentage. That's why it's called percentage, alright? Okay, you have to measure your returns in terms of what? In terms of a percentage. Make sense? Okay, so I'm just going to come up with a hypothetical in between. We can see that at I1.5, okay, let's say you increase your investment to I1.5. Now, I want you to observe this. At I1.5, this is your expected rate of returns. Okay, we see that if the blank expected rate of return is 5%, okay, the green is 3%, in between it should be somewhere maybe 4%. Right? And you can see that the borrowing cost here, has it changed? It's still 3%, right? You can borrow any amount of funding or liquidity from the bank at the same interest rate at 3%. So what do we observe here? Okay, we can see that the gap in between tells us that there is still your expected rate of returns is still higher than cost of borrowing. But is it a lot higher? It's not a lot higher. Okay, so it's probably 1% higher. So we can see that because of expected rate of return still exceeds cost of borrowing, the firm is anticipated to what? Invest even more. So it will invest and invest and invest up to where? Here. Okay, until your expected rate of returns equals to cost of borrowing. Again. So let me repeat. When you explain interest rate effects on your investments, these are the few things that I will expect you to illustrate. Number one, you want to illustrate what happens to cost of borrowing. Okay, so you have to deduce cost of borrowing went up or went down. Number two, okay, in the scenario that it goes down, you can see that holding the expected rate of returns, okay, to be constant initially, your expected rate of returns will exceed your cost of borrowing. Okay, let's pick this scenario, right? Okay, of course, cost of borrowing can go up. then you explain the other way around. So when this is a greater sign, this will lead to what? Higher net expected returns. Okay, when net expected returns goes up, then you want to relate to higher investments. Then you can use your ADAS framework. Higher AD, okay, unplanned inventory depletion, so on and so forth. So these are the two terms that I expect you to start to use. First one, you can deduce it from the extract. The second one, this is a very specific terminology that, okay, I want to see net expected returns, expected rate of returns. Okay, so please include the word expected, because they are not actualized yet. Okay, they are forecasted. Okay, and this is very good in the sense that you can also talk about the rise in interest rate. They are talking about the same thing. COB and IR down here is talking about the same thing. Okay, so if cost of borrowing or interest rate goes up, okay, let's go through this. I'm going to use another colored pen. Okay, so if it goes up, then your cost of borrowing will exceed your expected rate of returns. Then your net expected returns will fall. Okay, and your investment level will fall. Okay, in other words, this is a upward movement along your MEI. Okay, so we are moving downwards and moving upwards. So essentially, okay, this is a what? A movement along your MEI curve using interest rate factors. Okay, you can see that your y-axis is interest rate or your cost of borrowing, right? So you can see that this is a movement downwards and upwards. Okay, if you're familiar with your demand, the law of demand, okay, this is something similar. Okay, your price, okay, and your quantity is inversely related, right? Now your interest rate and your investment is inversely related like that. Okay, so this is how you derive. Okay, now I'm going to blow up this, and I want you to focus on the right hand side. So the right hand side simply tells us that this is a non-interest rate factor. Holding your interest rate the same, you have expected higher returns or lower expected returns. So these are some of the determinants that will cause your expected returns to increase or decrease. Corporate tax, innovation, okay, business expectation. Okay, so if your school uses expected returns, okay, in your answer, you can use that. So let me repeat, the difference between the left and the right, okay, is a non-interest factor. Non-IR factor. That causes your entire MEI to shift left or shift right. Okay, the one on the left is an IR factor. Okay, if you use demand and supply concept, it's a price factor, non-price factor. Okay, a price factor will lead to a movement. Okay, a IR factor will lead to a movement. A non-IR factor will lead to a shift. So today I won't be covering much of this because they are non-IR factors, yeah. Okay, but if you want to find out how to use that, you can stay back, okay, during the break and ask me. Okay. All right, so I have covered MEI in depth. So I'm going to move on to page 102, effects on C and NX. Okay, page 102. Sorry for jumping around. So for page 102, okay, I want you all to replace this illustration with MEI. Okay, so just now I have penned this down already. Okay, you want to use step 1, step 2, and step 3. Okay, instead of up to here. Okay, refer to step 1, step 2, and step 3. Called effects on expected rate of returns and cost of borrowing. Okay, so I just put a mental note here. Use EROR versus COB, okay, to deduce the level of investment. Okay, next I want to move on to the secondary effect. So like I've said, if you're running short in time, then you have to deduce how much can I write, right? So if you lower interest rate, okay, you must have a specific objective. You want higher investment, higher AD. Okay, so investment will always be your number one priority. Number one. Always start from I, go to C, and this one optional. Why do I put optional for net exports? Because I think it's really too excessive. Too much. Okay, so how does interest rate affects consumption? Okay, so you can see here, okay, interest rate goes up or goes down affects your cost of borrowing. This incentivizes or disincentivizes borrowers to borrow. I want you all to add in one more thing here. The effects of interest rate on your interest expense on big ticket items. Okay, so this is the key phrase that I want to add in. Okay, just like the expected rate of returns and cost of borrowing, this is what I want you to add in. So you can see that, especially for consumers, that they borrow to purchase big ticket items. What are some of the big ticket items that consumers or household will borrow? Okay, they will probably borrow to buy a what? Okay, a Ferrari, right? Okay, car, house, university, school loans, or anything that is big ticket items, okay, that you need to take a loan. So you can see that when interest rate goes down, okay, interest expense on big ticket items will naturally go down. Okay, you are going to enjoy interest saving. And likewise, if you realize that interest rate goes up now, okay, have you all heard of your parents complaining that interest rate has went up? Have or not? Don't have. Okay, and your mortgage getting more costly. Then in that case, okay, C will go down. Okay, so anything that you borrow, okay, is going to incur interest expense. Okay, banks don't lend you for free, right? Okay, if any banks lend you for free, you let me know. Okay, I want to befriend you because I want to borrow from you as well. Okay, so interest expense. Net exports is potentially hard. I will cover this, okay, under lesson 22 and 23. Okay, so this one I will build it in the future. You need to have concept of exchange rate, hot money, hot money and exchange rate before we can deduce the effects on net exports. Okay, so this one is hard. I will explain it next week. Okay, at the very least, I will expect C and I to come up. Clear? So monetary policy is very specific. Yeah, targeting at different components, C and I. And you realize that we don't use concepts such as post-tax profit anymore. Because interest rate does not affect your post-tax profit. It's not taxable, right? Agreed? Okay, and you realize that disposable income is not used here. Why? Because interest rate doesn't affect your disposable income. Disposable income is net of tax. It's not net of interest. So I've seen a lot of students are spamming what disposable income here and there. Don't use that. Okay, using too much, okay, too excessively reflects what? Reflects that you don't understand the concept. Okay, have you added the key requirement here under interest expense? Added already, So the side joke here is this. Recently, Mr. Teo has been considering whether to buy a new house. You know, sell my house and move up to a new house. You know, you often hear your parents saying that when you sell your house, you're going to make a profit, right? Yes? Okay, but now you can actually see that the borrowing cost has actually went up a lot. So the idea of servicing a bigger loan, and having to pay more interest expense is not very appealing, right? Yeah. So this is some of the considerations even for myself. Okay, if I want to borrow to buy a new asset, I also don't want. Okay, so I will quickly run to the objectives. Okay, so the objectives are very easy. Look at page 102. 102. Sorry, 103. I'm so sorry, 103. 103 actually gives you some of the problems that expansionary and contractionary monetary policies can solve. So they are actually stated very briefly. I will teach you the thought process, how to use the book. Okay, so now let's go through economic growth. So for economic growth, I want you to think through. Okay, remember the thought process last week or 2 weeks back, okay, is if you want to propose a policy, you always have to know what are the root causes, right? Yeah, so what are the root causes, or what are the root issues, or what are the subtypes of economic growth that we are concerned about? Always start from the back. Economic growth. What are the types of economic growth? What are the main types of economic growth? Type it out. Yeah, AGPG, yeah. Okay, AGPG. So now, remember, monetary policy is a demand side policy, especially interest rate, right? Okay, so for a demand side policy, if you want to influence your growth, actual growth and potential growth, which one do you think is most likely to be influenced by a demand side policy? Which one? Okay, so you can see that it's most likely that if you want, okay, if you are going to propose monetary policy, demand side policy, okay, it's most likely to be a what? It's most likely to influence your actual growth, right? And you want more actual growth. So if you want more actual growth, what do you need? Do you need to conduct expansionary or contractionary monetary policy? E or C? So in this case, you want to conduct expansionary monetary policy. And in order to conduct expansionary monetary policy, what must happen to interest rate? Remember, expansionary means higher AD, right? Okay, so what must happen to interest rate in order for AD to go up? Okay, so your interest rate must fall. Okay, when interest rate falls, or your cost of borrowing falls, okay, it affects household because household will experience higher what? Okay, well, household will actually buy more big ticket items because interest expense on big ticket items will fall. Firms will invest more. Why? Because expected rate of returns exceeds cost of borrowing. This will result in a higher net expected returns. Okay, and they will increase in their level of investment. So this is how you want to deduce systematically, okay, for all your problems. Can always focus on the demand side. Does it mean that monetary policy cannot influence potential growth? Can or not? Well, it could. Okay, but it's not the focus. It depends on what you want to talk about. Right? So if you were to invest in capital stocks, in the long run, this will lead to capital accumulation. Potential growth can increase when you have more capital stocks. But is it what we want to talk about? This is not the focus, right? Our focus is primarily the demand side. So you always have to learn, okay, what is the main and what's the side. Okay, and you have to learn your constraints. Knowing doesn't mean that I have to write it out. Okay, no need to vomit everything out, right? Okay, just show what is necessary. Okay, now let's go through unemployment. Okay, what are the types of unemployment? Quick. 3 seconds. 3, 2, 1. Come on. Okay, we have structural, demand deficient, and frictional, right? Okay, another term is cyclical as well. Now tell me, okay, what is monetary policy good to solve? Which one can we correct? Best to correct. Best fit. Always look at best fit. For JC Econs, a lot of students say that I can argue. I'm not interested in arguing. I'm interested in going straight to the point. Tell me directly, what is the most obvious thing to solve? Which one? Then you can see that Like I said, always look at what is the type of policy. You're using a demand side policy as to correct demand deficient. Right? Okay, so what type of monetary policy do we need, ladies and gentlemen? Expand or contract? You want more or you want less? Okay, you definitely want less unemployment, right? Lesser demand deficient, right? So you need to what? You need to have higher AD, right? In order to have higher AD, then you have to use expansionary monetary policy. So Mr. Teo is not in the exam hall to tell you what policy to use. You have to deduce that yourself. So in order to conduct expansionary monetary policy, lower interest rate. So for those that are looking at page 103, I believe 103, this is how we derive all this. Okay? Price stability. Okay, so what are the concepts or terms that are often related to price stability? And in other words, what happens when prices are unstable? What is the problem related to price instability? Okay, we have inflation and deflation. This inflation is not a concern. Okay, so now inflation, let's go through. What are the two types of inflation? Okay, if you cannot deduce that, then too bad. Okay, demand pull and cost push. And if we want to correct inflation, which type of inflation is likely to be corrected by monetary policy? Which one can monetary policy correct? Demand pull or cost push? Okay, go for the more obvious one, demand pull. Theoretically, cost push can. Theoretically. Okay, but it goes through a very long route. Okay, just go straight to the point. So if you want to correct demand pull inflation, what do we need? Expansionary or contractionary? So we have to deduce, right? When demand pull inflation arises, it means that is it too much economic activities or too little economic activities? Okay, what is the circumstance here? Okay, inflation occurs when your spare capacity is exhausted. There's rapid increase in AD, right? Rapid increase in your AD, spare capacity is exhausted. So we need contractionary monetary policy. Overheating already, right? To lower AD. Okay, and in order to propose contractionary monetary policy, what do we need to do with interest rate? We need to raise interest rate. Okay, we raise interest rate so that interest expense on big ticket items will go up. Household will cut back on their borrowing. C will go down. Okay, we raise interest rate to make what? Okay, in order to create what? Okay, your cost of borrowing to go up, and expected rate of returns will be lower than your cost of borrowing, and this will cause your net expected returns to fall. Okay, and when it becomes negative or when it has fallen, okay, firms will cut back on their investment. This is how you want to think through. Okay, likewise for deflation, deflation can also go through the same thought process. Okay, I will just cut short in deflation. So deflation, if you have stuck to what we have covered, in the program, is a malign and benign form of deflation. Okay, a malign form of deflation occurs when there is a fall in AD. A benign form of deflation occurs when there is a increase in AS curve. Okay, so this one I have tasked you all to watch. Okay, if you didn't watch, if you don't understand what is malign or benign, I cannot help you. Okay, I suggest you all to take another look at the topic inflation again. Okay, so to be more specific, if we want to target inflation, we want to target what? Deflation. Okay, we want to target fall in AD, a malign, a harmful kind. Okay, and we need expansionary monetary policy, and we probably need to lower interest rate. Okay, so this is how we deduce from the back to the front, back to the front, back to the front. Now, the last part, Okay, on balance of payment. Balance of payment is exceptionally tricky. Okay, balance of payment requires you to look into which account you want. Which account. Okay, so I will probably cover this a little bit more in the next 2 lessons, but I'll give you all a teaser, okay, on why balance of payment can be tricky. So for instance, okay, if you want to improve your balance of payment, like I say, I just give you all a teaser. Okay, if you understand, good. If you don't understand, never mind. Okay, we'll do it another day. Okay, so you can see that if you want your balance of payment to improve, then you have to further break it down into what? Current account and capital and financial account. Right? So you can consider the illustration of interest rate rising. Okay, so I just go through one scenario here. Okay, you see what you can pick up from here. When interest rate rises, how is it going to affect your capital and financial account? You can see at number 1, hot money inflow because of higher returns in domestic assets. I'll cover this more next week. Hot money inflow, you can see that this is going to improve your short-term capital and financial account. So this will go up. But at the same time, you can see that, okay, with an inflow of hot money, this will lead to a currency appreciation. I'll cover this next week again. A currency appreciation will result in erosion in your export competitiveness. Okay, and the erosion of your export competitiveness will lead to fall in X minus M. So you can see that it can be potentially opposing. One account and the other account is opposing one another. So when you want to talk about this, I would suggest you to isolate the accounts. Okay, either talk about this or this. Don't talk about both. Otherwise, you cannot get a conclusion. Whether is it going to improve or worsen. Is everyone clear? Yeah, I'll talk more about this in the next 2 lessons. Okay, so this one I just potentially fast forward. Okay, so focus on your first 3 objectives first. Very, very important. Now, limitations, page 103. I'll show you, okay, what are some of the ways, okay, to study this. So I have listed several limitations down here. So for limitations, you want to look into these 2 broad concepts in your school textbook or your school lecture notes. Okay, so limitations, you can break it down into constraints or unintended consequence. So constraint simply tells you what inhibits the effectiveness of monetary policy, right? So I just go through a few examples. Maybe I'll go through the first page. Size of multiplier. Okay, although we broadly learn this under fiscal policy, right? Size of multiplier is still applicable. Okay, a country with a small multiplier size is going to inhibit the effectiveness of monetary policy. Okay, we are looking at the extent of your AD increasing. Okay, so this is size of multiplier here. Okay, interest elasticity, investment and consumption. What does it mean here? Okay, I'm just going to show you, okay, using page 65 again. If you were to flip to page 65. Okay, everyone, can I erase this? I erase. So you can see that your MEI is sloping downwards, right? Now, okay, I'm just going to play around with the gradient. So you can see that when your interest rate falls, okay, if your gradient of your MEI is significantly more interest inelastic, we call it interest inelastic, is less sensitive to interest changes, we can see that your level of investment will increase lesser. Do you see that? So this is once again PED coming to you. If you don't understand PED, it will continue, it will haunt you in endless cycle. Right, so we are looking at what? Okay, the interest elasticity of your MEI curve. Okay, if it is elastic, okay, then your investment will be more responsive to interest rate changes. If it is inelastic, then your investment will be less sensitive to interest rate changes. This is what it means. So now if you were to put it back, okay, this is probably under MEI again. I'll put it interest elasticity. Okay, this is 0.2 will probably come here. Okay, liquidity trap, you can actually see a liquidity trap is only applicable for expansionary monetary policy. So what does it mean? Well, it simply means that when you lower interest rate, what is the minimum that you can lower to? What's the minimum? Expansionary monetary policy is related to what? Lowering interest rate, right? So you can see that often, okay, the cap or the minimum that you can lower to is close to zero or zero nominally. Okay, so if you cannot reduce beyond zero, it means that you have what? You have issues promoting higher C and I. Because zero is the cap. But a lot of students will use this incorrectly. Okay, they will propose contractionary monetary policy. So liquidity trap is not pertaining to contractionary monetary policy because interest can go up indefinitely. Right? Okay, there is no cap upwards, but there's a cap downwards at 0%. So this is also a constraint. Right, so what are some of the unintended consequences here? Then you can later on in the extract, okay, you can see that there are some potential unintended consequences. Unintended consequence, I would suggest you to look out for trade-offs. For instance, okay, if you were to conduct excessive expansionary monetary policy, what kind of problem may arise? Okay, demand pull inflation may arise, right? Okay, so prioritize trade-offs. I'm sorry I'm rushing a bit because I am running a bit short in time. So I just want you all to have a broad awareness how to study limitations, constraints, and unintended consequence. Later on in the extract, you'll see that it's presented quite differently. So exam purpose. Okay, I'm going to wrap this up. Number one, identifying the different contexts of countries. Some countries adopt interest rate, some countries adopt exchange rate. You have to find the correct one. Okay, so most of the country can only adopt one of the two. Next, okay, you have to illustrate how expected rate of returns at cost of borrowing is going to affect investment. This is the primary effect. Okay, so interest rate and investments are inversely related, but you have to use the correct terminology to explain that. I'll expect you to use that later. Okay, and secondarily, you want to talk about C. Net exports is an optional component if you can write fast enough. Otherwise, don't write. C and I good enough. Okay, so with this, I would request all of you to go for a real short break. When you are back, okay, we will go through the time practice together. Okay, I'll give you an outline and we'll kickstart with that. Okay, see you in a short while. Thanks. Alright, welcome back. For those who are back. Okay, we have to start. So once you are back, okay, turn on your camera. And I will give you a really simple outline to follow. A lot depends on what you can find in the extract. So for case studies, okay, I will emphasize this a little bit more, okay, during the case study workshop. Most of the time, okay, you have to look at what you're presented, okay, and not reading from the start to the end. Remember, when you read from the start to the end, it probably means that you don't find anything. You need to know what you need to find. Okay, so these are the few things that I would suggest you to look out for. Number one, okay, you want to look out what is the question type. Okay, so this is I'm assuming all of you know where to find a question paper, huh? So you can see that this question is a central bank based question, whether Bank of England should continue to implement expansionary monetary policy. Okay, so what's the basis of expansionary monetary policy? You have to deduce backwards. Okay, is it because that Bank of England or UK is facing a recession? Check. Or whether there is unemployment? Check. Okay, this is how we work backwards, Okay, this is your part of your one. And this is and you probably want to introduce what is expansionary monetary policy as a form of definition in your intro. So these two you have to check from the extract. Okay, and next, okay, you have to go on to break it up into should and should not, right? Okay, so the basis of implementing an expansionary monetary policy, okay, is to cross check whether these two are present. Okay, in the event that these two are present, which is quite likely, if not the question would be phrased like that. Okay, then you have to illustrate how your monetary policy works. Okay, how does it work? Okay, so you are probably going to illustrate the effects of interest rate and how does it affect C and I. Okay, so just now I have mentioned before, if you want to promote C and I, you need very specific terms. So I would like to see how you use interest rate down here to promote higher C and higher I. Okay, interest on big ticket items, expected rate of returns versus cost of borrowing. I don't need you to draw this MEI curve. I don't need to draw. This is just for understanding or illustration purpose. Okay, but I need you to explain it. And I need you to conduct the ADAS framework. Right? And you have to relate to what goal do you want to solve. If you want BOE to continue to run expansionary monetary policy, it has to solve a problem. What problem would you like to solve? Is it that you want to correct recession? Or is it that you want to promote higher employment? Okay, make sure this is clearly narrated in your extract. Okay, or clearly narrated in your thesis. So another way to interpret this should is the benefits of continuing. So the benefits of continuing should tally or should tie up with a macro goal. Okay, what macro goal can you achieve? Okay, that also works. Other than what problems you want to solve. Okay, they are the flip side of the same coin. Now for should not, okay, then you possibly find it a bit harder. Why shouldn't they continue, right? So for should not, you have to know that the framework, okay, that you can adopt here, okay, could possibly contain these two. Okay, consequence. I put it here, consequence. And constraints. So the UK Bank of England shouldn't continue because of what? Unintended consequences or constraints. Right? So you're supposed to identify either one of them. Either or. Don't need both. So you have to read the extract and tell me what is a particular constraint that UK BOE is having when they implement expansionary monetary policy. Okay, or what kind of problem can it create? Other problems that can create. So far so good. Either or, so you have to find this yourself. Okay, so you can actually see that the framework is more or less quite sound. All you need to do is just plug and play. Okay, plug and play means what? Okay, it means that checking all this is very crucial. Otherwise, will be rubbish in, rubbish out. Okay, so for my stronger students, I would suggest you all to work on your synthesis. Okay, so synthesis, you want to come out with justification. Justify whether should continue or not, based on what basis. Okay, you should continue, based on what basis you shouldn't continue. Okay, so I think I've pretty much given you all a good starting point to work on. Okay, what are the good thought process to think through before you approach this case study? Okay, I will give you all 25 minutes to execute this. Okay, so write it out in full. I'll see you guys back at 12 o'clock. Okay? Try not to refer to the answer key. Try to do it on your own at the best that you can. Unless you totally no choice. Okay, so 12 o'clock I'll see you. And meanwhile, I'll proceed to record the answers. I'll turn off my mic and my camera. Yeah, go ahead and start writing. Alright everyone, I'm back. So I'll quickly go through the answers. And before I go through the answers, okay, I would just like you all to, especially viewers out here who have not watched the outline, okay, you guys should watch the outline that I've conducted earlier on. Otherwise, you will not know the thought process behind the answers. Okay, so it's the thought process, okay, that is more important than what you write. Okay, you can only write based on how you think. Okay, so this is my suggestion. So once you are done writing, once you are done reviewing the outline, and once you are done writing, okay, this particular essay, okay, 25 minutes, I believe it's 25 minutes. Okay, then you can continue with this this video analysis. Otherwise, you can pause, okay, and you can do it on your own first, can? So I'm going to assume that most of you are done with your video, with the outline and the writing part. Okay, so I'm going to move on to breaking down the question. So I'm going to go through some variations of the question first. So remember just now I've mentioned to you that you can break down the question into benefits, cost, and constraint, right? So another way that this question can be asked, would be this. So they ask you to discuss the factors that BOE should consider to continue. So I'll just copy and paste here. This particular phrase, to continue to implement. So what's the key difference in these two question phrasing? So they are phrased differently, but the answering portion is the same, or the answering component is the same. So you can see that this is a thesis. The bottom approach is a thesis and antithesis approach. Thesis and antithesis. Whereas the one in green is they are presented in factors approach, benefits, cost, and constraint. Other than that, you can use the same approach for these two questions: benefits, cost, and constraint. So this is one of the more modern ways to ask. You may want to bookmark this and research a little bit more about how questions are asked these days. It's not saying that thesis and antithesis has lost favor. It's just that examiners, they like to change things or spice up a little bit more. Sometimes you change a bit of the framework, and students don't understand how it works. Now, I have gone through the outline. So this is what I would suggest. So first of all, like what I mentioned, define what is monetary policy. Identify the context of the problem. That there is a recession, unemployment. So remember, you have to deduce what is BOE trying to do first, and then you fit it like Lego. Then you want to look out for recession. Mention in extract 4 para 3. That's good. Then I faster fit it in. So the moment when you start looking from the front to the back, it means that you lose precious time because you don't know what you're looking for. So you have to make logical, smart guesses. So thesis should continue. So here are some of the things that I would suggest you all to put it optional. I didn't cover the tools of monetary policy in depth. All these will be optional, right? But we can already correctly deduce from the extract that the Bank of England is going to conduct expansionary monetary policy. The question told you so. Even if the question is silent about that, we can infer that recession, right? You need what? Monetary policy, expansionary monetary policy, cutting interest rate, holding at record low tells us what? This is going to be an expansionary form of monetary policy. So a lot of times you don't necessarily need to rely on one particular case material to make a judgment. The entire extract should be synchronized. You should be able to see that it's going to illustrate in a few different case materials that is going to be consistent, that is going to be expansionary monetary policy. So look out for extract or case materials that tells you that interest rate is going to fall or it kept intentionally low. Even for this diagram, base rate is simply a form of discount rate. What the central bank charges the commercial bank. You can see that borrowing costs, for commercial banks from when they borrow from central banks is going to go down. So when cost of credit is going to go down, they are going to what? They are going to lower the borrowing cost for the general economy, especially for household, for firms. So this is another way to deduce. Remember, there are multiple ways to deduce, but you have to think through what you want to illustrate. So this is where it starts to be compulsory. So consumers will make use of lower borrowing costs to purchase big ticket items because of lower interest expense. I probably forgot lower interest expense. Investments will be higher because expected rate of returns exceeds cost of borrowing. And this will lead to higher net expected returns. So these two will lead to a cumulative higher C and I. I hope you guys see that. Okay, so this is step 1. Okay, and step 2 down here, increase in AD. So you can adopt the 6-step process. I did not show the repeated increase in AD for a good reason, because I wanted to show an unintended consequence later. Otherwise, it's not wrong to show multiple increase. You can also show multiple increase, consistent with what we have gone through. Okay, so I just want you all to check whether you have adopted the ADAS framework here. Unplanned inventory disaccumulation or depletion. That is step 3. Okay, firms will hire more labor in the next time period. Step 4, because of unplanned inventory depletion. Okay, so workers is a derived demand. Okay, so step 5, you can state that, you know, when household have higher income, okay, so they are going to lead to multiple round of spending and respending through the multiplier process. And step 6, okay, will be relating to your goal. So you can see that these 6 steps are present. So things to look out for, especially I've mentioned this, is to correct the problem. So earlier on, the problem was recession. Okay, so the opposite of recession must be counteract with higher level of real national income and economic recovery down here. Okay, so these two must be present. You must make adequate link to what problem you like to solve. Otherwise, okay, it will be what? Regurgitating answers. Next. Okay, your antithesis. So you realize that it's quite lengthy. Like I've said, I don't need you to do corrections in depth. I just need you to identify which point, okay, are you going to correct. You can either correct a constraint or an unintended consequence down here. I'm going to break it into 2 halves. Okay, this is the breaking point. You pick one of the 2. So what is a constraint down here? You realize that earlier on, okay, we've gone through a lot of constraints, and I've made a specific mental note that constraints depends on extract. Okay, you cannot copy wholesale from the lecture booklet. Okay, otherwise you are not applying. Some of the constraints that you can see, let me explain. Number 1, okay, commercial banks are not resuming lending to repair on their balance sheet. So what it means? It means that, okay, they have probably incurred a lot of bad debts. Bad debts means what? It means that firms and households are not repaying their debts. And this is potentially detrimental. Why? Because this could lead to bankruptcy, right? Okay, if whoever that you lend your money to is not going to repay you. Okay, so you can see that right now, okay, Bank of England, okay, they have what? Okay, they have injected a lot of credit to the commercial banks. They have lower interest rates substantially as well. Okay, but commercial banks are not lending because of fear, right? They want to hold on to as much money or credit as possible. Okay, in case of adversaries. Okay, in case everyone start to lose faith in the bank, they start to make withdrawal all suddenly. So this is what we call, okay, a constraint. Okay, having a lot of credit to lend, okay, doesn't mean that banks will lend, right? Next, you can see that the fall in asset price, okay, is going to suppress C and I. Why is that so? Okay, you can see that a fall in asset price, like for instance, okay, your house, okay, if your house value has fallen, right? So this will make you less likely to consume goods and services because there's a loss in wealth, not income, wealth. Okay, and you can also see that households and firms, okay, they are saddled with debt. When they are saddled with debt, it simply means that, okay, when you lower interest rate, okay, household and firms are not going to spend more on C and I. They have to repay their debt first. So you can see that cumulatively, all these 3 inhibits C and I from going up. Banks are not lending, right? Firms and households are going to experience a fall in asset price and settle with debt. C and I still not going to go up. Okay, so you pick either of these, okay, to explain. Okay, so it was mentioned somewhere in the extract that there's inflationary pressure. So you can talk about unintended consequence when there is excessive increase in AD. Too much. Then this will beat up factor prices. Okay, demand pull inflation can arise when spare capacity is exhausted. Okay, and you want to talk about, if you want to go deeper, you can talk about what are the unintended, what are consequences of inflation. Okay, you can talk about erosion in your standard of living. Okay, you can elaborate a little bit more about that. Otherwise, I think this is fine. I use both here, constraint and unintended consequence. You pick one. Now, synthesis. Okay, let's work on your synthesis. What does synthesis requires? Okay, so synthesis requires you to justify, and justification requires you to pick an assumption to critique. So, justification number one, you can pick either of these. Okay, justification number one, time period. So you can see that UK economy has yet to recover, and there are evidence that expansionary monetary policy needs more time. Okay, so why is there more time required? If you look at the business environment ratings, okay, there is a fall in optimism, right? And this is going to discourage spending. So you need more time to be effective. So the justification here is, in the short run, we shouldn't discontinue. We should continue until monetary policy becomes effective. Now, the second justification is economic conditions. In other words, I put SOE here, state of economy. Okay, so state of economy can be used interchangeably. So state of economy tells us where is your AD. Okay, so what do we mean by that? For instance, if we were to promote AD to AD0 to AD1, this is along the spare capacity. This is good. Why? Because there is still ample spare capacity. But if you were to promote AD1 to AD2, this is no good. Why? Because inflationary pressure will arise when spare capacity is exhausted. Okay, so you have to justify which part of UK are they operating in. Is it the first part or the second part? So if it's the first part, then good, continue. If they are exhausting their spare capacity, then they should move on. They should not continue. They should stop. Okay? So I'm just going to go through an alternative down here. So this can be used under antithesis, under unintended consequence. So this requires you to understand hot money, and effects of depreciation. So I'm just going to list down whether you understood or not. I'll leave it to you. But I'll eventually cover this in the future. Under exchange rate. So all it tells us is when there is a fall in interest rate, there's going to be a fall in hot money inflow, and there's going to be a depreciation. And here's the catch. When there's a depreciation, this is going to lead to what? Higher import costs. So it's going to be more costly to acquire goods and services, especially raw materials from other countries, probably Iceland. They're going to import natural gas from Iceland, from other parts of Europe. A depreciation will make it more costly, especially your import costs to go up. This will lead to a fall in your SRAS due to higher cost of production. Cost push inflation. So this particular route is also acceptable. Only if you know how to use that. So with this, I hope you guys have some clarity on how to approach this particular question, especially the modern way of asking. The factors-based question, you may want to look deeper into researching this type of questions from the AYE question pack. Otherwise, if there's any questions for me, you can stay back and ask me. If I am not directly coaching you, and you have no direct access to me, you can drop me a comment under the comment segment. So with that, okay, I wish you all the best and I will see you all same time, same channel. Thank you. Bye-bye.